Moving over to the livestock sector, from options on retaining feeder cattle to the Cattle Price Discovery and Transparency Act, there was a lot to review this week. We were joined by the University of Nebraska-Lincoln's own Elliott Dennis on Tuesday to get his thoughts on the latest developments in the cattle markets.
Yeah, so this year is kind of an interesting year for producers who are thinking about retaining feeder cattle into January or even to March, April. And the primary reason is because of elevated feed prices. Normally we'd consider retaining feeder cattle, we have extra hay laying around, or we have some maybe corn stalks we have access to, and so we can put on the weight. But this year we need to be extra careful when we start to make those decisions because feed prices are so high. And so what we really want to do is if we have hay, we need to be testing that hay to ensure that we have good body score conditions going into the future, and also understand that we need to have a pretty good expectation of what price is going to be in January, because we can be putting in pretty expensive feed, and if we're not going to be getting that benefit back in the terms of really aggregate higher prices for the animals, then we could be actually looking at losing money by retaining cattle.
Something else that's been in the news lately is the Price Discovery and Transparency Act. They're looking to get that renewed. What can you tell us about how that's impacted the market, and how could that look going forward for producers?
Yeah, so this whole idea about price discovery has been pretty much ongoing since 2020. It's been on producers' mind, but really got ignited again once the packing plants started shutting down in March, April of 2020. And this really fueled the conversation about really what price discovery is, which is the way that cattle are discovered. And what that is it's negotiated cash, which is including negotiated cash and negotiated grid. Combine all that, we get negotiated sales. And a lot of formulas or contracts or grid pricing is based upon a base price. And that base price is generally derived from negotiated sales. And there's just been conversation about, certain regions are potentially more represented in that negotiated price. So for example, if we look at Texas, Oklahoma, New Mexico region, about 10% to 12% of that region sells cattle on a negotiated basis. We compare that to Nebraska, and it's somewhere in the 30 to 35% range. And so really what this bill that will be introduced again into Congress is to, among other things, to create regional minimums for negotiated sales that packers are obligated to purchase at. Now, how that gets set is going to be really interesting. Right now, they're saying that the minimum, if whatever that 18-month rolling window is, that's the minimum number of cattle that they have to sell. But other regions can't be more than 3 times as high as that. That's really important because given USDA's current regions, Colorado is not reporting a lot of the times, and they just don't sell a lot of cattle anymore. And so places like Texas, Oklahoma, New Mexico will probably already meet the minimum requirements if Colorado's included. That gives you just one example of how these policies or bills that are being proposed can have real impacts on the way cattle are discovered, in both now and into the future.
So we've got the Cattle on Feed report coming out on Friday, so that'll be out the day before this airs. What expectations do you have for that report?
Yeah, so one thing to keep in mind is that we have one less slaughter day this month than we did in the previous year. And so some of that harvest is going to be down a little bit, but it's probably largely a function of just one less day that's being reported to USDA. Placements are going to be up again. It's surprising that we can think that placements are going to be up again, but they are. So looking at those weight distributions across is going to be interesting. We know that Nebraska generally places heavier cattle. I would expect that trend to continue, and we'd probably see a lot of the lighter weight cattle start to fill up the Texas, Kansas feed yards. And then really what we're seeing is marketings are probably a little bit lower. Probably not significantly a lot, but it's definitely going to be lower. But like I said, it's largely because of one less marketing day. So those are some of the industry and analyst expectations that's compiled for about 10 or 11 analysts they survey, and that's kind of what people's expectations are going into this Friday.
And prices have been moving up on cattle over the last couple of weeks. What marketing or risk management advice would you have for our viewers?
Yeah, so as we know, the more volatile the market is, the more need there is for risk management. And so the government's LRP program is one program that people can consider, recognizing that you can only insure cattle with a minimum of 3 months, which means if I'm sitting here in November, the earliest LRP contract that I can get is in February. And so if we're looking for that short-term protection, looking in for the CME futures and options, if we're wanting to directly protect price, recognizing we still have some basis risk there, or if we're just wanting to take all that cash risk out, just looking at the video auctions, Superior, Northern Livestock auctions are ways that producers can protect that price. And recognizing that price risk protection is, or really should be a discussion anytime we make a business decision. For example, if we're deciding to retain cattle, looking at some price risk management options is definitely warranted, especially when we're experiencing more volatile pricing.